Welcome. Today we have Garrick Brown, who is retail extraordinaire master man.
Oh, well, I'm actually an economist by background, who has been in commercial real estate for 30 years. I started as a generalist with all commercial real estate food groups, so the office market, industrial, retail, multifamily. But really over the last 20, 25 years, retail became my specialty, especially, if you remember, going back to 2010, 2015's, the whole retail apocalypse storyline, which, there's no doubt, we're here in Sacramento where 25 years ago we had 7 malls in town. Now there's arguably one successful mall, one that's being re-envisioned, and that's Arden, that Centennial, the new owners, they do a really good job of rejuvenating problematic malls. We've got another Sunrise Mall, which essentially doesn't exist right now, wants to be reimagined.
And what is the Florida Mall?
Converted to something else, a different shopping center type.
Yeah. Okay.
And that was really where, I think my career took off, because nobody cares what economists say unless it's challenging. Right?
Okay, you're gonna have to explain that.
If things are good, nobody gives a crap what you have to say, because things are good and people are making money.
Right.
When people are nervous and things are scary, suddenly people listen to you. Now, there's a downside to that, because there's some economists that are notorious. I mean, for one thing, being an economist, your job is to look at risk. So you tend to be a gloomy dude.
Right.
All right. The old joke, would be, he's correctly predicted 15 of the last 5 recessions, right? Because we always think, or at least there's a good number of us that, we see risk, we live with risk all day long.
So the joke I think of with The Economist is something somebody told me 20 years ago or so. And it was, an economist is the only guy who can be wrong 100% of the time and still keep his job.
Oh, that was a weather person.
Pretty similar, the reality is that, there's no real way to predict the future. What you can best come up with are likely scenarios.
Yeah.
Right. But when it came to the retail side of things, one thing that I noticed, and this is probably where I became more prominent, and because I was publishing a lot, was just that there were deeply challenging times, and retail apocalypse. First off, it's a great clickbait title, right?
Yeah.
The truth to it was, if you worked for Sears, it was a retail apocalypse. Yeah. If we had year 2000, we had about 1,800 regional malls in the U.S., which was too many. We're down to about 1,100. If you're the owner of one of those malls, it felt like a retail apocalypse. But what people don't realize, the retail ecosphere is monstrously huge. Malls only accounted, even at their peak, for about 8% of the real estate. Most retail real estate, it's your local grocery store with the shops that are mostly, local restaurants, local services, so forth. And that has been relatively healthy throughout this whole thing. So a lot of it was looking at, what's working, what doesn't. And then, of course, there's all sorts of different patterns that emerge. I mean, right now, there is some basic truth to the economy being K-shaped, that either you're doing really well or you're not doing well at all. And the consumer spending is really kind of an outsized manner being driven by the highest earners. So how does that translate into your shopping center? Well, if you're a discount-oriented retailer, you can't open stores fast enough. If you're luxury, you're probably doing okay. What you don't want to be in retail is the middle.
right now.
And that's where the carnage was, and it still is.
Mhm.
And the carnage hasn't ended. Just this year alone, Francesca's liquidating 400 stores there. There's just been a slew of closure, bankruptcy announcements, and so forth. That isn't going to end.
Mm.
But for the most part, if you look at actual vacancy in these shopping centers, there are new tenants taking it. Some of them are non-traditional. I mean, the stuff that I track in retail, we didn't consider car washes to be much of a retail category till a few years ago, and suddenly, private equity discovered they love recurring revenue subscription models. And literally, as far as growth categories, car washes have been one of the fastest growing that I've ever seen in 30 years.
Right.
We're literally, chains like Quick Whack, which is here locally, they're putting up 40, 50, 60 car washes a year. And the thing is, nationally, there's about 300 of these chains that are all going through similar growth rates, where we're not talking about like a 5% growth rate. We have 100 stores, we're opening 5. No, we're talking about, we had 30 units, we're opening another 30, where they're doubling up. That's also happening with aesthetics, med spas.
What's a med spa?
So a med spa is different than a beauty salon in that, you can get beauty treatments, but you can also get your Botox done.
Okay.
So the idea that
it's more, it requires a little more technical proficiency.
Don't they do the intravenous health?
Some of those, the IV guys,
and all that.
and that used to just be a Vegas hangover thing.
Yeah.
It did. It was a Vegas airport hangover thing.
Yes.
That's all it was, because most logical people don't like having giant IV needles stuck in them.
Yeah.
Not anymore.
Yeah.
In pursuit of beauty,
Okay, so let's back up. I want to hear more about like your story. Like, how did you get to be a guru in this space? Like, where did you go to school? You said you studied economics.
Yeah, so initially I studied creative writing, University of California, Irvine. And then about 3 years into it, I was working my way through. So I was operations manager at a bookstore, and it kind of irked me that I realized I was learning more at the bookstore than for the most part at my classes. And then I realized, geez, what am I going to do with this degree? Now, first off, the reality is people who can communicate are in demand in every field.
Yes.
Right. So it's not as bleak as, I hear some people always like to bag on any sort of liberal arts degree. And frankly,
that was my degree.
Yeah. Well,
liberal arts.
Well, so the thing is, look, there are applications.
Yeah.
I just realized.
My says you want fries with that?
Well, I just realized that I didn't want to be a teacher. Okay. And that's what I thought. And luckily, I had to take an economics class as kind of a prerequisite, just to check a box off. But I ended up having a great professor, because I always was more literal-minded than numbers-minded, and I assumed
the humanities.
Yeah. But the weird thing is if you gave me like algebra, okay, I was a D student. But I could solve all the word problems, no problem. If you asked me to show my work, I'd get that part wrong somehow.
Right.
I had a professor, though, who approached economics as the story of how we live with our money.
Yeah.
And a light bulb went off, and I was like, wow. And so I really started following that and realized, no, this isn't as dry as you think at all. It touches on everything. It touches on culture. It touches on history. It touches on all of these things that we normally would say those are the humanities. I think are critical. And frankly, I think we actually have gone maybe the other direction a little bit too far, because
you mean away from the humanities?
I worry about the tech bros. I worry about people who don't have a sense of history or culture.
I agree. And I want to add to that. I feel like, and I'm not in the universities right now, but what I hear is coming out of the universities is no longer good, solid history, good, solid writing. It's more agenda-driven stuff. Like, hey, we want you to learn about this topic or this topic. Not, hey, this is what this is.
I hear that.
History.
I hear that, but I also hear a lot of that from people that are propagandists themselves. And that's what worries me is I feel that we've, as a culture, and this is really I think our biggest challenge right now is that we have channelized ourselves so that there is no overarching U.S. culture anymore. It's left versus right.
Yeah.
It's and frankly, it's going to lead us to disaster. I would argue we're almost there.
Yeah.
The fact that,
and I'm not trying to be partisan by it.
But there's got to be a common. We don't have a common narrative as a country anymore,
right?
And that's not going to stand for long.
Yeah,
and I think that and let's pull back because I think that's a different topic.
I want to go back to universities a little bit because I completely agree. I feel like it's going like I got my degree in liberal arts, and I heard somebody say something years ago. It was like back, especially in the '60s and the '70s, like the liberal arts were the guys that became your managers because they knew about a variety of different things. They were the guys who could write reports and manage other people because they had the interpersonal skills. And I thought, okay, that makes sense. And I don't see that anymore.
I don't see well-roundedness.
No.
And that freaks me out.
And there's like you're saying, it's like, okay, these guys are going all tech, but I don't see anything in the middle. And then there's kind of, whether it's art history or whatever it is, they're learning whatever it is that they're learning, but they're not learning like, okay, this is math and science and history and kind of getting a good, well-rounded education. I don't feel like it's there anymore. And like I said, I'm not in the university.
Well, that's one thing why the tech side of everything is starting to become more popular. Welding, construction, and they have the college auto mechanics, electronics with all that. I'm seeing more of the colleges attempting or
to go towards skills training?
Go
towards skills training. That's correct. And that's what's really needed.
And the trades, look, we
that's where the
ask any contractor, anybody in construction, the dire shortage of skilled tradespeople that's out there. And let's face it, one of the other challenges that's happened at the same time over the last 40 years is as a society, we invest less and less in making education accessible, while at the same time, higher education it's just skyrocketed. We're talking about 30, 40, 50% above where the costs were when we were going to school. I mean, actually in California, it's much more extreme because what we had, and one of the reasons we became the tech universe was if you graduated and you were a resident of California in the 80s, you could go to a community college for $50, unlimited credits.
Yep.
Your books cost literally 3, 4, 5 times more than your tuition.
Yeah.
If you went to state school.
I did. I went to junior college, and that's what it was. It was like $50 a credit or something like that.
Yep.
Completely accessible. And at the other end of the spectrum where you get like the elites, well, the idea that you can't go to an Ivy League for less than $150,000 a year. Okay, that's basically what's happened with the Ivy League. Is they said we're the Louis Vuitton here. Mm. We're going to have scarcity as our driving profit motive, right? We're going to reject 99 out of 100 applicants. That's great for the prestige if you're lucky enough to get in, but it's not good for society.
Well, another thing that I'm seeing is that talking about the universities, some of these courses are broadcast online. So literally anybody can get the MIT courses or the Harvard courses that are being taught by the Harvard professors. and you can just get them in your own
Well,
home.
yeah.
I don't know that a lot of people.
But that was something that, if you remember the pandemic, okay, in economic circles, everyone was looking at what happened in the pandemic and said, oh, wow, okay, our ability to do Zoom and all this new technology, this could
That
radically
propelled us, in my
disrupt.
opinion, that propelled us 10 years in advance. Because
Yeah.
we were going in that direction, but we did it in 1 year.
Yeah.
Boom.
Oh, yeah. Like
That
for
was
Mike and I,
amazing.
when we were meeting with clients, as soon as COVID hit, like within 2 weeks, it's, we're just doing it on Zoom.
Well, and that was the thing I think that nobody anticipated when all the lockdowns. So I'm in retail, right? We're thinking in retail, if you went to any retail broker or landlord in April or May of 2020, it was like going to a funeral. Every broker became a grief counselor.
Yes.
While at the same time going, oh my God, am I even going to ever make money at this again? And then oddly, what happened? It was the office market that actually took the real hit. Retail rebounded within 18 months. It actually had, because so much stimulus was pumped into the economy, people were spending like, drunken sailors on shore leave. And we had some incredible retail years, 2021, 2022. I mean, of course, it helped spur the inflation spiral. But the reality is, if you go back to that time, nothing played out the way people thought. Right? If you show me anyone who would say that retail would end up being stronger, nobody said that at the time. And if they say it now, they're lying because they didn't say it at the time. Same thing. Nobody thought the same with the office market.
That was going to happen.
But one of the things that everyone was speculating that didn't happen was that these new technologies could disrupt education and healthcare. And it hasn't really happened.
No.
Okay, so talk on that, like with education.
Well, the idea that
Zoom. Now I know that my kids went to Zoom classes, and I know that at least what I've heard anecdotally is the research is, from talking to professors.
Well, so I meant higher education, right? And I think that's a big part of it was that's K through 12.
Yeah,
it turned out to be horrendous, right? Yeah. The kids learning, so much of it turns out is social, being in the right place with your classmates. And I think the social repercussions were still not recovered from.
I think much of that's still rippling through society.
Well, and these things aren't helping. Okay.
That's true.
They're not helping at all. Gen Z, and I don't want to be one of those old, because every generation since ancient Rome has had old guys bagging on the young guys. This generation,
they're worse than ever.
But there are some profoundly disturbing statistics coming out of Gen Z. Higher levels of depression, self-harm.
Oh yeah, absolutely.
They don't do the crazy stuff that my generation, Gen X, did. Like the drunk driving isn't a big problem, where it was in the 80s, and the types of harm seem more inward, but inability to communicate, social anxiety disorders. I've hired a few Gen Zs. Over the course of my career, I've been in operations with some brokerages and hired brokers where I had young brokers that I had to talk into picking up the phone. Where they're like, well, I text them, I email, and like literally I'm like, well, you want to really freak someone out? Send them a handwritten letter.
Yeah.
You'll stick out in their mind, right?
You will.
But it is really interesting because, you'll see some statistic where, young men and women are just feel very awkward around each other. And
yeah.
The other thing that I'm noticing is we don't see entrepreneurship being taught as regularly.
No.
I have a feeling that small businesses, and that's what keeps the retail going, is entrepreneurship. They set up little restaurants, burger places, hot dog places, fingernail, whatever. They just go in and start doing something that they like to do.
And most people don't realize this because even with, say, fast food, they think of McDonald's as this monolithic. It's franchises.
Yeah.
Yes, there are some large franchise groups that will have hundreds of units within some of these, but a lot of them are mom and pops.
Yeah.
And
What percent are franchises? What percent are mom and pops?
varies by the chain. The bigger and more successful have higher barriers to entry.
Mm-hmm.
And one of the challenges with franchise businesses, and we see this every time there's a downturn. There's the buy a job phenomenon. Okay, where you're a mid-level executive. Okay, let's just say this happens this year. Let's say AI investment turns out it's a bubble, and there's a lot of disturbing numbers that. Again, this is my economist gloomster thing. I'll be shocked that we get out of this year without a recession. Okay. But let's say this happens. In fact, supposedly Meta's getting ready to lay off about 15,000 people, is what I heard this morning.
Which company?
Meta.
Oh, Meta.
Facebook,
Yeah.
Whatever they want to call themselves today.
Yeah.
Let's say you're one of those people. You have a bunch of money saved up and you're sick of the rat race. You're sick. Hey, I'm gonna open a restaurant. I want to open a sandwich shop.
Right.
Well, the low barrier to entry guys, one of the problems with some of these organizations is that they're more about selling franchises than actually selling, say, sandwiches. Right. And some of them will achieve growth at all costs to the point where will they protect your territory? If I open XYZ sandwich shop, are you going to sell a franchise to a guy who wants to open across the street from me?
Mm-hmm.
And I think we can all look at some of the bigger ones and some of those chains. Let's just put it this way. It used to be a joke that Subway would open a Subway in the bathroom of an existing Subway if they could.
Yes. Yes.
Because each time they do it, it's $30,000 just upfront money for the franchise. And then you get whatever the X percent of gross sales, so forth. And you got to buy your stuff from them. So there's different franchises that have different levels of entry.
Mm-hmm.
Chick-fil-A is hot as can be. You're not getting into Chick-fil-A without at least $10 million in liquidity, period.
10 million?
And an extensive resume of having operated restaurants before.
Correct.
Right.
Same thing with McDonald's. Okay, the gold standard ones are very difficult to get into.
Okay.
And so that's where the franchise world gets very confusing and interesting.
Now, my question was simpler, which is of
overall,
100% overall, what percentage are franchises? What percentage of storefronts are franchises? What percent are mom and pop?
If you look at all the QSRs, I would put it about 80% are franchise, 20 are corporate.
Well, look at the gas station where you get gas today. That's all changed.
Yeah.
I remember they were all privately owned. It was just a real simple gas station. You go in, you get your car fixed. Now you go in, you buy your groceries now. You got Walmart with a gas station. You got Sam's Club, Costco. Now the big thing that I'm starting to see is the Buc-ee's. The Buc-ee's.
Huge.
I mean, that thing is gigantic. Have you ever been to a Buc-ee's?
80,000 square feet, and it's a tourist attraction. It's a convenience store that's a tourist attraction.
It's a destination.
I went out of my way to go to a Buc-ee's.
They're creeping this way slowly. They're in Arizona now.
Are they?
I'm not sure they're going to want to come into California, but they'll be close. They're just building another one in Tennessee. They built a real big one there off of Highway 40 in Crossville. Now they're building another big one, even bigger than the one they just built in Murfreesboro in Tennessee.
Which, think about it. 80,000 square foot convenience store. Now, granted, it's like there's each one of them has pretty much a food court inside.
Oh, yeah.
They're known for the cleanliness of their restrooms. That's one of their big things.
What's real interesting about them? They have a A-frame that they put out front with all the income salaries, all broken down to the store manager. The least paid person is the people that clean the bathrooms, $20 an hour. And that's in Tennessee.
Yeah.
So they are beating everybody with the payroll. Also, they're just flocking there to work because they're paying them more for good quality. And you go in there, it's the most friendliest people.
Well, that's like the In-N-Out rule,
Yeah.
right? In-N-Out has always paid the best of any fast food QSR because they demand the best quality people.
Yes.
And they get it because they reward it.
Yes.
And it's not the race to the bottom that unfortunately, and see, this is where I see, now, of course, In-N-Out is corporate owned.
Mm-hmm.
They don't franchise.
Right.
Right. And they have avoided going public because they don't want to be destroyed by the pressures of Wall Street.
Yeah.
And the way chains fall apart is it starts something small. Like, you know what? I can get a better deal on these pickles.
Yep. And then the pickle flavor changes, and then they kind of go, oh.
You know, we can get a better, the ketchup. Why don't we, we don't need Heinz. I found this brand that
it's too vinegar.
Mike in Tennessee makes. Let's get that one. And it's death by 1,000 paper cuts. And then the next thing you know, you're going, is it me? Or did these used to taste a lot better?
Yeah.
Maybe it's just that I'm an old man and I'm grumpy. No. It used to taste better.
Or the buns used to be this big and now they're this big.
Yeah.
Because, and the thing is, in these boardrooms, it always works the same because someone's got to make their bones, right? You got to edge that 0.5% up.
Yeah.
And this is how chains kill themselves. This is how Carl's Jr., when Carl Karcher owned it, he was a quirky guy, but he understood the burger business. Unfortunately, he went public. Eventually, his own company forces him out.
Yes.
Right? They end up buying Hardee's, but they've been declining in unit counts for 10 years straight.
Yeah.
And been ceding ground where suddenly you go and you look at, what's hot in the burger world? Well, it's not the legacy guys. The legacy guys mostly are closing. McDonald's would be the exception. Wendy's is closing like between 4 and 6% of their stores this year.
Really?
Wow.
Yeah. But that's because they've got a lot of pressure from some of the upstart brands. Of course, my brain has a brain fart as I'm trying to think of the one that's growing the fastest right now, which would be Habit. Yeah.
Oh, yeah.
Habit is just on fire. But of course, look at what their product is. It's good quality and it's affordable. Mm-hmm. And which is difficult because let's face it, one of the challenges that we've had since the 2022 inflation spike is that prices didn't go backwards. Right? They don't go backwards unless you get a depression or a recession. Okay. So that's the thing. What you really want is wages to increase. But we see this across the board. If you're going to build anything, it's costing between 30 and 40% more than it did 5 years ago.
Yeah.
Okay. Used to be, could you get a Happy Meal or a family meal at a fast food joint for $12? Yeah. Now it's 17.
Yeah.
And that crunch has led to a whole bunch of strange things. One is that for a while, we actually saw in retail that chains would differentiate themselves and say, we're not fast food, we're fast casual. Well, and that always meant that they had a slightly different price point. Yeah, fast casual would be, we're a little bit more about the quality. At least that was the sell, right? Okay. We're higher quality, better ingredients. We're going to cost a little bit more. Yeah. The problem is the difference in those price points was wiped out 2022 since then. So it's now it's not even a thing anymore. It's just, no, you're a fast food, you're QSR, whatever.
There are places you can go to right now and do a sit down, and it's pretty close to the same price.
Chili's has revived themselves on that alone.
They have a burger, and I watch it on the news or the advertising. They have a burger that is like a 1/4 pound burger, and it's a beautiful looking thing. All the fries you can eat and all the drink that you can have for, I think it's $11.99.
Yeah.
You go to Carl's Jr.'s, Jack in the Box, Burger King, whatever, and you get 2 burgers, fries, and a Coke, and you're $27, $30.
Yeah, you're almost like a sit down.
Yeah, you're almost better getting waited on. They come and serve you. You get, the quality of the service is better than just going in and picking up and eating it.
And the way they turn a profit is because a certain percent are going to say, you know what, I'd like a cold beer with that too.
Yeah.
Right. Or they end up buying the high margin, the alcohol. And, at the end of the day, that's been where Chili's went from, because if you look at the restaurant world, what was happening, same thing. You didn't want to be in the middle. Mm-hmm. All the growth was either at the highest end or the mass market fast food. Who was suffering? It was casual dining in the middle. It was the TGI Fridays, bankrupt last year. Hooters, bankrupt. IHOP closing stores. The way IHOP navigated it was they went from mostly corporate owned to refranchising, basically selling locations to franchisees so they take the risk on. Right? So if IHOP, which is doing fine now, but if IHOP were to declare bankruptcy, you don't see a lot of closures when a corporate restaurant chain that relies on franchising goes bankrupt. A good example that's happening right now, Fat Brands, owner of Fat Burger, Twin Peaks. Literally, they racked up about 20 different banners that they were buying on credit in the last 2 or 3 years. Whole thing collapsed. They just filed bankruptcy. But because less than 10% of their locations, includes Round Table Pizza, for example, less than 10% of their locations are corporate owned, they're not impacted. So Fat Brands is going to go away. Someone's going to swoop in and buy these individual banners up. Some of them will slowly decay. Some of them might get revived. Some of them will just be the same old thing.
But the store will still be there. They'll still be producing a product.
Yeah, because it's the mom and pop.
Yeah, different name. Somebody else will just take it over.
The one downside to whenever something like this happens is that there are some franchise operators that just go and buy distressed chains. And if they buy them cheaply enough, they just know that they have a monthly check coming in and they have no interest in either reviving the brand or... So sometimes you'll see this happen. Logan's Roadhouse is like one of those where it used to be a lot bigger, a lot more places. Slow decline. That's because the original operator went bankrupt. And then, what ends up happening is some of these players in the space, it's, let's face it, it's a business. So there's going to be people motivated for multiple reasons. And in some cases, if it's just, look, I don't have to put anything into this and it's a check you're going to get.
Yeah.
So what do you think is going to be happening in our future? Where are we headed? Because I know for me, when COVID hit, everybody kept saying the world's going to come to an end. I was totally opposite. And I said, this is the beginning of something that's going to be great. But we just have to go through the process. It's the same thing that we went through with 9/11. We had a pause in the marketplace. As soon as that pause was over with, everything shot off like crazy. That exact same thing happened with COVID. We went through a pause, and all of a sudden, real estate and a lot of other things just took off like a rocket. Now, I was battling with a ton of people that saying, "Oh no, this is it. We're going to have another 2008. It's all done. Bail, get out."
I thought the market was going to go down.
Yeah. Joel and I had many conversations. I said, no, hang on to your hat.
I felt like it was right there towards the peak. It was like,
there were a lot of people that in April, May 2020 were like, I'm getting out of the market, right?
Yeah. In our industry, I can't tell you how many buyers that were in contract walked away from the contracts and said, done. And then they said, I'm going to wait for the market to crash. It says, you aren't going to be able to buy because if you don't buy this now, you will not be able to buy this house at this price in about 4 or 5 months. That's exactly what happened. Yeah. Well, out of and they still don't own a house.
Here's the thing. If you remember, in the run up to the 2008 collapse,
I was heavy in that one.
Well, and everybody all the loan guys, it always was the same thing. And of course, the reason of the collapse was that there was toxic loan product that had been repackaged, a lot of junk, and we had done things to make it too easy to buy a house. Correct. Stated income loans. Okay, we could just make it up. the adjustable rate stuff, where you suddenly go from this rate you could afford to a skyrocketing rate. And the way that it was sold was, look, real estate never goes backwards in value, which is normally true, except there.
They got away from the fundamentals. When you change the fundamentals of qualifying, you change the fundamentals, and you just give away free money. Well, the government actually mandated that everybody can be able to buy a house, and the banks had to come on board with it. So there's just so many different layers of how this went.
You start messing with the basic principles of the free market too much. You start engineering stuff too much. You got to be really careful about what you're going to set off. And the law of unintended consequences always gets you. Now, right now, I look at where the stock market is, and it's up over the last 5 years about 30, 40%. All of it's AI, all of it. You literally take out the valuations of the top 10 tech companies investing in AI, and it's flat. I am deeply concerned. So one of the things, I'm having flashbacks of 2000. Okay, and I remember the Super Bowl, March 2000 or February 2000. Quarter of the ads were .com, is pets.com, the sock puppet. 6 months later, they're all gone.
You also got to remember that was Y2K too coming in. That was 2099. I'm sorry, 1999.
Well, so this was the 2000 Super Bowl. So we had just gotten past that delta, right? But everybody was deeply concerned that there was going to be a crash, right? Now, everyone who invested in those .coms made the right bet. Yeah, this was going to transform the world. It wasn't going to do it in 18 months, though, right? It was going to do it over the next few years. I fear that's what we've got going on now. And it's funny because in economic circles, this might sound ridiculous. It actually is becoming an indicator of Super Bowl advertising.
Yes.
And it's for a very simple reason.
Is affected by the Super Bowl, believe it or not.
Well, so this year, 30-second spots were anywhere between $8 and $10 million. Wow. Now, if you've got the money to blow on that, and think about this, if you're AI, all right, why are you advertising to this? It's one thing if I'm Domino's Pizza, I got an immediate impact. I got an ad, you're watching football, yeah, call Domino's.
Or Budweiser.
Whereas these are normally products that you'd see on Bloomberg, Fox Business, CNBC. Why are you going for this? It's usually to get your stock price up or because you're about to go public. Well, if your stock price is already maxed out, this is one of the things you do. And it was the same thing with the crypto bowl a few years ago. And then we had crypto winter. Guess what? Within 6 months, right? If you remember the ads with Larry David and all that, this was what, 2023? Crypto winter sets in 6 months later and all those companies are gone. Sam Altman-Fried's in handcuffs. So we have this year where, guess what? The magic number, 25% of the ads are gobbled up by AI at these ridiculous prices. The market valuations are through the roof. If you just look at in the last year, the trillions of dollars, I think it's 8.4 trillion in the last 4 years. It literally was, and sorry, I don't have my data in front of me, but it literally is the equivalent of the GDP of Italy, which is the 6th largest economy. Right. Okay, or 7th. So we've got all this money being put into AI, which is obviously going to transform things. Is it going to transform things this quickly? And here's the big indicator beyond Super Bowl anecdotes, is that in 2000, so there's a measurement economists look at called the Case-Shiller PE ratio. And what it does is it looks at the overall index, what stock and equities are trading for. And it applies a formula that looks at the trade price versus earnings. And typically, if the PE ratio is 20, you're getting kind of a deal. You're getting stock that you're basically buying at 20 times earnings, but that's a good investment. It's got runway to grow. 30, it's getting a little frothy.
Yeah.
Means that you're paying a lot. It's kind of the inverse in my business in commercial real estate of cap rates, which is a return on investment, right? Mm-hmm. If I invest in a property that's got a lot of risk, I might have a 10% cap rate, but if it pays off, I did really great on the investment. Maybe it's a fixer-upper where I just re-tenant it, and suddenly the value is better, and I can spin it off and sell it. If I have a 4% cap rate, that's 4% return on my money. That's not for the risk involved. That's not great. 3%, you'd say, why would I do that? It's buy treasuries.
Right.
So the inverse would be the Case-Shiller, and the inverse would be that when you get into the 30s, that means that the price of the stock was so high, you're probably not going to see a lot of return. When it gets into 40 territory, it's overvalued. The tech wreck of 2000 happened when that ratio hit 44.
Okay.
It's at 40 today. 40.
Right.
If I'm in the market, I'm going to go and get into something more tangible, right? I'm either, the thing is that there's so much global turmoil right now. I don't know if I trust the bond market. Mm-hmm. Real estate doesn't go away. Get your money out, get into real estate. And I get it. I'm a real estate economist. So yeah, does it sound like I'm saying something self-serving? Yeah, it probably is. But it doesn't change the fact that where the market is at is a little bit scary. Now, if I'm investing in commercial real estate, AI probably is going to end up being just as disruptive eventually as what COVID turned out to be. I mean, Dario Amodei, the CEO of Anthropic last September said, within 3 to 5 years, 50% of white collar entry level jobs will be wiped out by AI. Now he's geeking up his product. Let's be clear about that. Yeah. And even when he seems to be the one that's most in tune with public fear of AI. So he'll couch things and say, we have to be careful about this. And I give him props for that. It's not like some of these other asocial, apparently almost sociopathic types that seem to be in big tech. At least there's a huge big tech backlash that's going to come with all this AI disruption. Because if Dario's prediction is true and those trillions of dollars invested are in the promise, and his promise is we're going to get rid of those pesky employees. That's what his promise is. But if you were to go through and just look at the BLS numbers, the statistics for employment, and you took out 30% of the office using categories, financial services. I did this exercise. Unemployment, which right now is sub 5%, immediately goes to about 16%. Remember, COVID, the peak unemployment rate in May 2020 was 16.2. It probably really was 20 to 25% briefly because of furloughs. That's depression level era unemployment. So here's the challenge of AI. All this money has been invested on a promise that if it delivers, craters the economy. But if it doesn't deliver, can this bubble diffuse itself on its own in the stock market? Sometimes these things happen, right? Now, the current war that we're in has seen the indices all drop somewhat. So, the Dow hit 50 a few weeks ago. It's not there. That's not necessarily a bad thing. The problem is are the right stocks deflating? And they're not. The stocks that are deflating are consumer stocks. They're Target, they're Walmart.
Right. For
the very real possibility that the longer this war goes on, we're at $100 barrels. We end up getting to 130. We'll surpass the all-time highs that we've recorded during the inflation surge of 2022. And we're talking about national gas price averages of $5, which means California will be $7 or $8. Yeah. And all of that is going to be yet another tax on the consumer. But what didn't go backwards are the AI stocks. So, Is there a possibility that there's a way out of the AI bubble with AI deflating on its own? Yeah, but ultimately this is a bet. If I'm going to bet on it, I'm betting on getting out.
And move your money into hard assets, like real estate, tangible things.
Yeah, and normally I'm not big on any of the minerals. A lot of that's about fear mongering to old people.
Right.
But silver and gold have been taken off.
Yeah.
Right? It really have been taken off. So if you're going to make a move like that, just don't buy goofy coins that nobody really collects. Like, buy real silver and gold,
Or bars.
Yeah. Just
Something
the second it's like a decorative coin, it's a collector's item.
Buy the real coins.
Buy the real, yeah. But so I look at that, and that keeps me up at night, and I'm deeply worried.
So are there any good opportunities out there in the real estate market?
Well, here's the thing.
Anything? I mean, you're in the middle of all that.
Yeah. So,
and Joel and I are all over the country looking at a lot of different things, and we're seeing some. Really
certainly on the commercial side, one of the challenges that we've had. So office and remote and hybrid work, even though the trending has been more and more reversion to normal patterns, the reality is that it really hit the markets hard. The tech markets particularly. The irony now is that tech is where the AI layoffs are happening. If this had been happening a couple of years ago, you probably would have had a lot of workers that were decided to work from home. Because think about it, if I work for Google in Mountain View, chances are I live in the East Bay probably.
Yeah.
Right? Chances are I'm spending 2 hours a day either on BART or in a car, going round trip. And if your experience is like most workers, I mean, I managed a staff of 30 at the time. And what I saw was that a third of my workers disappeared. Don't know what the hell they were doing.
Mm-hmm.
Lazy bastards, every last one of them. Except a third of my workers worked themselves to death because they didn't have separation work at home. So they would get up, roll out of bed, work, and then late into the night and burn themselves out. And then a third of the workers that just acted like normal, right? That being said, if a tech-based recession would have happened in, say, 2022, the first thing you got to learn as a young worker, and this is the problem with remote work, out of sight, out of mind, when a downturn hits, out of a job. If you don't have a relationship with your employer, if you don't have a relationship with people around you and all things are equal, unless you're some rock star that gives them some sort of juju that they can't get anywhere else, who do you think the axe hits when it starts getting swung around?
Right.
Yeah.
Right? So
they're just a number on a list, and they just...
So the challenge we've got with the office market, it hit the tech markets hardest. So you go to San Francisco, it's 25% vacancy. What do you do with the space?
More than that, but geez, office space.
At one point, 40% of the space was available.
Yeah,
but some of it was occupied. But it was users wanting to sublease out unused space. It's gotten a little bit better in the last year. But I don't know that I have the guts to invest in an office building unless the pricing is so cheap I can turn it into something else.
Yes.
Retail, on the other hand, I would be looking at outdoor strip shopping centers, anchored or unanchored. Grocery anchored's great. Okay, those things are pretty much bulletproof. Malls, not so much, unless you got like a real sweetheart deal and a great location that's solid fundamentals. Net lease investment is always tricky. Net lease, for those of you who don't know what it is, it's a single tenant building. It's really low demands for a landlord. At most fast food joints, Raising Cane's, you get them in, they're going to do a 25-year lease typically. And if that's your building or it's land that you owned and they built on it, a land lease, you just sit back and collect a check.
Dollar General. They're selling off a lot of the Dollar General's investors. They come in, you can buy the land, buy the building, and Dollar General leases.
And they'll do it.
10 to 15 years, 20 years.
And it's triple net leases, so they take care of the utilities, they take care of everything, right?
You just get a check. And insurance.
But the tricky thing about those is it's all about the health of the underlying lease in that retailer. And I'll just give you some stark examples. Walgreens and CVS, 6 years ago, were gold standard tenants. Okay? People lined up to do those deals, and they did them at 4 caps because it was money in the bank, right? So a 4 cap, that's a low return on investment, but it was viewed as risk-free. What happens 5 years ago? Opioid settlements start rattling in the industry. Meanwhile, there's a push by health insurance companies to sell prescriptions directly to you. Like you probably, I get calls like once a week, it seems, from my healthcare provider saying, we can send these to you 3 months at a time. Well, it's because they're cutting out the middleman.
Right. Yeah.
That drove Rite Aid's final collapse, and both CVS and Walgreens have been closing stores left and right. If you had one of those leases, now you got a 16,000 square foot empty building that happens to be a very awkward size. It's not big enough for a small format grocery, and it's too big for a small user. The only people taking that space are opportunistic. Dollar stores are taking them, but only if they get a great deal. And your deal that might have been $3 a square foot in rent in value to a Walgreens, that once they closed and you've re-tenanted it, now you're getting $1.80, $2. So you took a big hit. So that's the one challenge with net lease is know your tenant.
Well, and you can't predict your tenant's future anyway.
You can't, but and that's the one thing where that 25-year lease that you thought was great.
Yeah.
That's also the downside, right? Because
if you're with McDonald's, you're probably going to be fine. They've been around long enough. They tested. They're not likely to go anywhere.
Let me give it perspective. 30 years ago, if you were to look at a list of the top 10 retailers in the United States, Sears was in the top 5.
Yep.
Yeah.
Okay. In fact, I need to dig up some of these old lists because I guarantee you half of them are gone.
Yeah. So
net lease is attractive, and if you're buying a fast food building, it might be $3 million. That's within reach for private, higher wealth individuals. Just be careful and make sure that you know the real credit picture of whoever you're leasing to. Medical office all day, all day, all day, all day, all day. In fact, I think a smart play would be if you could find office buildings on the cheap that you could convert to medical office. Mm-hmm. Would be a very smart play. Industrial, yes, but the e-commerce wave of the last few years is over. Mm-hmm. And you got to put things in perspective. For a while, everything was about e-commerce. And
when you say e-commerce, what do you mean?
So Amazon, over a 15-year stretch, bought, built, leased over 150 million square feet of industrial space. Mm-hmm. If you drive down Interstate 5 heading to Southern California, you go by the community of Tracy and you look off and there's all these giant buildings. They're million square foot buildings. Those are all Amazon. Okay. If you ever fly into the Ontario Airport, the Inland Empire in Southern California, as far as I can see, you see these giant buildings. Those are all e-commerce distribution that are there because that's as close as they could get to the Port of LA, our biggest incoming port. Now that wave is over. No one's ever going to do what Amazon did. A lot of people thought, oh, well, grocery hasn't been disrupted. But what grocery stores realized was, wait a second, why would we build all these distribution for delivery when we're already close to our consumer? And we've got to have freezer and refrigeration space.
Right.
Let's make the stores the distribution centers for delivery.
Yeah.
And either we'll do it ourselves or we'll outsource it to Instacart, we'll outsource it to DoorDash, whatever. That's increasingly becoming the model. Target was in the middle of building a giant DC chain for same-day delivery, and then they started realizing, you know what, we could do a lot of this from our stores. So the new Targets that are being built, and they're going to open about 30 of them this year. It used to be 20 years ago, the average Target store was 75,000 square feet. Right now, it's 125,000 square feet. The new store is going to be 150,000 square feet, except the selling space, same size, 125,000 square feet.
So it's all
back of house
and
for delivery. So the action in industrial has shifted from mega bulk warehouse, giant 500,000 square feet, to more smaller service bay type stuff. So smaller buildings, more divisible, stuff that you can put an auto body shop in, right? Services that are always out there, maybe not as glamorous.
Now, when you say small, do you mean 10,000 square feet or do you mean 2,000 square feet?
Either or. Yeah, so both.
But that lower end of
yeah.
footage.
So one of the things I looked at was the average size of industrial deals the last few years.
Or a building that's wide enough in the front that you can actually divide and make them into the smaller spaces and lease it out.
Divisibility is always great. And I think divisibility is also something that applies to retail. You know, one of the challenges that has come with, say, the drugstore space is they're not buildings that are easily divided. Right?
Right.
The HVAC system, you'd have to completely replace it, right? But if you have a building that's divisible, then you can kind of, you've got options if something bad happens with your tenant.
Right. Well, you have a strip mall.
Yeah.
Large building and 6 tenants.
I mean, look, the most amazing thing that came out of COVID for the retail world was that nobody in the business actually thought that retail was as resilient as it was.
That is true. I remember back in 2020, everyone thought retail is going to die.
Yep.
It's going to get killed. Half the stores are going to be gone and never coming back.
And tell you what, you know, if you look at the bankruptcy watch lists and how they exploded, the rate of bankruptcies, the store closures, the restaurant industry racked. 2020 was a bleak year.
They even talked about office space, office buildings, because everybody was working from home. All these big office buildings, just this office alone, nobody came in.
Yeah.
And that's the challenge that with AI on the horizon.
So now all of a sudden the business is saying, why do we need all this extra office space? Let's cut it in half, because we're only going to bring back half of the people because we don't need the other ones. Either they're laid off and or they're going to permanently work remote. They don't need to pay for the office space to house the employee.
Well, and I think one of the things that was interesting to me about how this has all played out in the office market the last 6 years since COVID was that initially, because we didn't actually have a downturn, you know, we technically had one negative quarter of GDP. We didn't have the 2 in a row rule, which is what economists look at. And of course, we had dumped so much stimulus money into the economy that then there was this kind of boom. The reality is in the office market, you saw a lot of employers take advantage of that circumstance and go, you know, we could save a bunch of money, right? You had others, though, that started to emerge to say, here's the problem with remote work is it's really, it's harder to manage. It's like what I went through, where a third of my employees, I didn't know what they were doing. And then the other third they needed to take a break. But the whole thing of workplace culture becomes really challenging. So everybody wanted to bring stuff back. But if we had a downturn and you were under an imperative to cut costs, you would have encouraged work from home, certainly from your most reliable people. You know, hey, I know that I can trust Josh to get the work done. You know, I don't have, all I know is, you know, especially if it's the kind of work where there's a product that you create that you just can't fake, right? Now, if your job is to answer phones and you don't have metrics for measuring productivity, that's a lot more where you got to have people where you can see them, I guess. But what the real challenge is, just as the office market seems to be improving the last couple of years, and Sacramento's been behind that curve because a third of our office space is used by the state.
Right.
And the state unions were fighting return to work orders. That's going away this year. But the challenge now is what's AI going to do to that workforce?
Mm-hmm.
Personally, what I think is going to play out is I think the AI bubble bursts. I think that there's a pause in AI and that somebody is going to end up the winner in this consolidation that'll happen in the AI world. And it just
global crossings kind of blow up, which is you have this producer that created all this fiber everywhere, and when they went under, other people absorbed it for pennies on the dollar.
I think, I don't know if it'll be, because what I think is going to happen, the one thing that's different than the dot-coms is that some of these are already the most profitable companies. I think what will end up happening is that, that either like a Google will step up and buy all this stuff out, or somebody will end up, and the number of players will reduce. And I do think eventually AI starts to live up to some of these promises over the next few years. I do think that there's one thing, because you ask even the creators, they don't know exactly how some of these work. And to me, the real question is language learning models that drive AI. Are they actually capable of critical thought? I don't know that they will ever reach that point. What they're good at is patterns,
Right?
Yeah.
Right? They detect patterns and they draw from everything and they replicate patterns. That's not the same thing as being able to. Here's a good example. Anthropic created a vending machine that they put in the San Francisco Bureau of the Wall Street Journal. And all the people on the floor could connect with it via Slack and say what they wanted to order. And they just programmed the vending machine, sell whatever. Your only job is to make a profit and sell the goods that the people in this newsroom ask for. Within a week, the reporters had it ordering tungsten, had it ordering fish, giving away PlayStations. They talked it into communism.
Oh, my word.
So it was ordering shit and giving it away. Because AI doesn't have critical thinking abilities.
Right.
It's like, you ever beat up on an AI for fun? I like to do this, right? So I do a thing where I track, 20,000 different chains, how many stores they have and their plans and so forth. But, I have to do an inventory once a year and like go through and be like, all right, how many stores is Walmart at? Now, if I call someone at Walmart because they're so big, I never get the straight answer because they don't even know, right? So I'll, sometimes their website's good, but, I'll go to AI and I'll be like, okay, Claude, how many stores does Walmart have right this second in the United States? And every once in a while I'll just say, no, you're wrong, Claude. Do better.
So basically you're having an argument. I remember when Lexus first came out and they were in the cars. You could have an actual argument with Lexus. It was so much fun.
Well, and the thing is, it's, it tries to please you, and they've dialed it back from like a year ago, but it tries to please you. That's part of the programming. But that's also where you get all sorts of false positives and things and the hallucinations, right? Like if I ask it, give me 10 reasons for this to occur, maybe there's only really 3 reasons that this is occurring. It'll make up the others, as opposed to saying, I don't know.
Yeah.
It doesn't have the critical thinking ability.
I don't know. You have to tell it to tell you, I don't know.
Right. And if it had critical rational thinking, it would be able to say, I understand your question, but I can only detect 3 reasons for this trend that
part of it
seems
is
solid.
The question that's being asked. You don't say, give me 10. You say, give me all the reasons for this. Because then it'll determine if it's 3 or 4 or 5.
Yeah, but then it arbitrarily determines those too.
Yeah,
and again, it's like anything else with data, garbage in, garbage out.
And that's okay because you didn't ask to say, if you say 10 and there's only 3, it's going to try to make something up. Well, but if you say, give me all the reasons.
Actually, I do that. I mean, when I'm talking to AI, I ask it to come up with what I think is more or less an unreasonable number because I want it to actually think rather than just populating crap.
Right.
Because when I ask it and say, okay, give me give me all the reasons. It just gives me an arbitrary number, 3, 7, 5, 9, whatever, that it thinks of. It doesn't even think its way through, because I can think of 25, but it can only think of 7. I don't believe that.
See, but I think
so then
ultimately,
I say, give me
though,
50, and then I look through it and say, okay, which ones are reasonable here?
see, and this is something academics still are trying to figure out, though. The language learning models, can they eventually teach these machines to have critical thinking abilities? I think probably not. And I think that is going to differentiate how far AI actually goes in disrupting us, right? Because right now, what is disrupting are coding jobs. Well, coding jobs aren't critical thinking, but they're very mathematical, right? It's very clear cut. Creating websites, very mathematical. Now, when I hear that, oh, well, yeah, it's going to do all these customer interface jobs too, I'm like, are you sure about that?
It's already doing them.
Well, it is, but it's going to have
starting.
some limitations at some point, because will it have the critical thinking skills that you really need to deftly manage difficult situations? Now, granted, a lot of people don't have those skills.
But you have to understand that past experiences of a human being is different than teaching an AI.
Right.
So my experiences that I've had in the past over 40 years of doing real estate is way different than you can teach an AI. So I think the human relationship between the client and the agent in real estate is still going to stay connected.
I mean, I hope it eventually is. So I actually asked Claude. Claude, what is the promise of AI? And it gave a really great canned answer, which was that I'll eliminate grunt work, I'll make you more productive, all of that. Now, granted, I don't think that the investors on Wall Street believe that for a second. They think it's about getting rid of employee counts and boosting profitability. But I do think that eventually it will disrupt. And I think it'll disrupt more than past technologies, because usually people are afraid of technology, aren't really getting that on the backside, the new technology ends up creating new jobs.
Yeah.
AI, I think, does have the power to be a little bit more disruptive than stuff in the past, but I do think there's going to be limitations. I just think, though, we are going to be in trouble if we don't slow it down and have a bit of a breather and be able to plan the disruptions better. I think the last thing we need is another injection of chaos into our society.
Yeah.
And I think that we've got an awful lot of chaos going on right now. And that keeps me up at night.
And we look at Ford and what they did with how they built cars and stuff. So all the buggy builders went out of business. The buggy whips went out of business. The horses, the harnesses for the horses. And then it went into that. So that was a huge disruption in the marketplace at that time.
Well, a lot of those guys went into handbags.
That's right. They moved into different things.
Serious. A lot of those guys that did tack, Hermes, a lot of the, all of the elite handbag guys now, the ones that have a long history, they go back to saddlery.
Right. That's correct. But if you look at the people that actually worked and built the buggies and everything, they just moved over and started working and building cars. So the job description changed. They had to learn a new skill. So I think what we're going through right now with AI, people are going to have to learn some kind of a new skill, technology skill or something, or they're going to flip burgers. But and I think right now we're going through a transition that's probably more, like I agree with you, going to be more effective in change than what we've gone through with all the other changes. It's going to affect us.
It's one of those things that if it all happens all at once, I think it'll be a little bit too much for us to handle. And that really deeply worries me. And I don't have any fantasies of, no, it's Skynet, the Terminator. No. none of that stuff. But the reality is if we start looking at structural unemployment being in the high teens, that's nightmarish stuff, because look how disruptive things are already. Like,
The question is if people lose their jobs, is there replacement jobs that they can go to with a little bit of training? And
I think it's different, because I completely see, like, with what Mike and I do, we use AI as much as we can. And
Right.
what it allows us to do is it allows us, where before we could only get this high and do this much, now we can do this much. So it allows us to do more things. That also allows us to hire other people to do things because we're now able to.
But I think that there's a small and a large business divide here too, right?
Yeah.
That in a way, this can be an equalizer for the independent business person, the small
Right.
business, that it does open up the ability to do a whole bunch of things that you wouldn't be able to afford to do. But the reality is that corporate job, that corporate workplace,
part of it is
it's going to be eliminating.
Right, part of it is what you could afford to do, but the other part is it affords you the time, because you can conserve on time, spend less time doing this. Like in your case, you spend a tremendous amount of time doing all the research and everything by hand. Well, AI is coming in and cutting that time. You're getting a similar result, but you've cut that time down to 2/3 less.
Right. Right.
So you're only working a third.
So then what happens is
which then opens the door to do more things.
Be able to do more things. I think that's what's going to happen on the corporate side as well. There's definitely going to be people that are, okay, your job has just been taken, or this whole section's job, we now need 5 people instead of 35. I've talked to friends who are in the coding, and they're like, yeah, he basically can do the job of 10 people himself with an AI, because it goes so fast. Now, but seeing the other side, I think it's going to morph so many people's jobs. I think they're just going to shift.
But what worries me already is we have, over the last 40 years, seen the prosperity gap grow. The K-shaped economy is real.
Yeah.
The income disparity, which impacts all of our business, it impacts people's ability to buy homes, right? If AI acts as an accelerant on that, and we already have a deeply divided society, and I don't see us being good at coming up with any sort of practical plans at the political level at this country, really the last 20 years, it seems like that it's been very difficult to have any sort of cohesive strategies. I mean, again, if we're talking about 16, 17% unemployment, and remember, our national deficit now, which, we haven't bothered to deal with. The last time we didn't have a deficit was the Clinton administration. We keep running up these bills and not paying the bills off. And eventually, we're going to hit a place where we cannot access capital to get us through a crisis. And that's the kind of thing that keeps me up at night, that the politicians of both parties have been utterly reckless when it comes to dealing with the issue of the deficit.
Mm-hmm.
Okay. And that's just a fact. Right now, what are we blowing? $2 billion a day in Iran? That adds up. And the fact of the matter is, if suddenly we are dealing with some sort of economic driver that accelerates this problem, now we got 16% unemployment, there's a point where you got to start worrying about blood in the streets type stuff, because societies eventually correct themselves. And,
So talking about that, I am perennially impressed with the degree of resilience which we have to be able to overcome stupid decisions.
We've got lots of practice.
Yeah. For example, just like the federal debt, like how do we even get to here?
Right.
And then where is that point? And so I totally get that. And then on the other side is, when do we go to a full chaos, literally blood in the streets moment. Is that a long slide? I look back at it and try and get a reference for it in the world, and I think of like the 1930s, the 1940s, where there was chaos across the world. I don't know if it'll be that. I don't know. I don't know what the impetus is to all of these things. I just look and I see that just as you're talking about, both sides are very dogmatic politically, and back in the 30s, it was very much like, oh, this is the right thing to do. This is the right thing to do.
Well,
and there was a lot of dogmatism
a
throughout.
lot of ideological thinking, which frankly, I'm a student of. Government should be about picking up the trash. Government should be about boring crap and just making things run. Look, and I get it. This is bleak, and a lot of it's just speculative. But all I'm just saying is, there will get to be a point where societies correct themselves, and I don't know. I look at the third. I'm looking at 1780s though, like French Revolution, get the pitchforks out kind of stuff.
Yeah.
That all keeps it, but back to reality.
Is that we end up with something like a French Revolution scenario where people are just wholesale slaughtered, or
right. And for those who haven't studied the history of the French Revolution, it was one wave of slaughter after the next, ending with the strongman, Napoleon, coming back, and the peasants didn't get jack out of any of it. It was just blood in the streets for about 10 years, and then a ruthless tyrant that wants to invade everybody. And
he did quite a good job.
He did, but the problem with ruthless idiot tyrants is they never know when to walk away from the table. It's like any gambler on a bender in Vegas. They never leave the craps table after the hot roll. They just stay there and they keep going for it. They never know when's enough. And, look, let's get back to reality though. Where I'm looking at the economy this year is, I think that we have an incredibly elevated risk of recession.
And it's due to the AI.
I think AI is one factor. I think that the tariffs, had President Trump just did the typical Republican stuff, deregulation, tax cuts, this would be a booming economy right now. His tariff policy has been this misguided disaster, and he's introduced so much uncertainty. The retailers I deal with, they don't know how to, they're all either trying to get their supply chains in the right place, which you can't do when, the president, think of it this way, when the Federal Reserve is going to make a move with interest rates, they purposely put it out there as far in advance as possible. They try to telegraph what they're going to do to not disrupt and upset markets, because businesses need certainty to plan any sort of growth. When it's chaos, when it's like, oh, you know what, Brazil locked up Bolsonaro, so I'm pissed off and I'm going to declare this or that. And, oh, you insulted me, Canada, with an ad, I'm going to change the tariffs today. You are injecting so much chaos that you are creating your own economic headwinds. Now, I wish that with the Supreme Court ruling, he would have just done it. So he could have yelled and screamed at the justices, but then let it go. $290 billion being refunded would have given an economic spark. He didn't do that. Those headwinds are real. Job growth, there just simply hasn't been any real job growth in the last year. And the stock market growth has all been AI. It's been a flat economy. Mm-hmm. And it should have gotten a boost from the tax cuts. It should have gotten a boost from deregulation. All of those things, and we could debate whether or not with the deficit where it's at, it's a good time for tax cuts. But the reality is that old Republican playbook should have sent markets zooming. The tariff policy has done the opposite of that. And now the global adventures, who knows what's going to happen? There's always the whole problem of unintended consequences. Frankly, Iran, period, 1953, democratically elected guy, Mohammad Mossadegh, wanted to westernize the nation. There was one problem, which is the British were stealing their oil. The predecessor of BP had signed a deal with the former king. We get to do all your oil exploration, and we'll give you 15% of net profit. And of course, they did creative accounting, so they didn't get squat out of it.
Mm-hmm.
He says we're going to nationalize the oil fields. He does. The British are pissed. First, as Devon Attlee is the prime minister, they try to engage us. Truman's like, you know what? We like this guy. He quotes George Washington. Truman's out, Eisenhower comes in, and Britain, Churchill comes in. Churchill's like, no, we're going to stick it to this guy. What ends up happening? We help engineer a coup where we take him down, we install the Shah. He ends up being in house arrest the rest of his life. The Shah is Western friendly. That oil deal gets redone. So the Iranians get to keep 20% of that. And meanwhile, it's not all BP. It's split between 5 American oil companies and BP. The problem is this. The Shah ends up being a repressive jackass. Mm-hmm. And those people that Mossadegh wanted to bring into modern era to provide education for his country, they end up going to religious mullahs and becoming radicalized. And here, unintended consequences have ways of kicking you in the ass. It's like us helping, the Afghanistan invasion, the Soviets, 1980. We end up funding this guy bin Laden. This is the problem if you don't think things through deeply. And I am deeply skeptical that where we're going right now has been thought through. So all of these give me more reasons for caution about the economy because, between the trade policy and alienating all of our allies, and now these global adventures, and apparently Cuba's next, all of these things are going to start to impact the economy more and more. It's going to infect global economic flows. There's going to be a point where, for example, 10% of our debt is held by the Japanese.
The Japanese?
Mm-hmm. Yeah.
Really?
Yeah, T-bills. In fact, 30% of our global debt is held by foreign governments.
Right.
What if we piss them off to the point that they just say, we're going to dump all of these T-bills. We're not going to invest in the U.S. anymore. We don't like the way they're behaving.
It would be bad.
It would be very bad. Yeah. It instantly would send bond rates through the roof. Our national debt would probably increase by $1 trillion or $2 trillion just in interest. So these are all real things. And so when I look at the landscape right now, I'm, granted, as an economist, we're supposed to look for risk. So yeah, I sound like a pretty gloomy dude right now.
Mm-hmm. So
and I'm definitely
seeing risk in multiple places.
I'm seeing a lot of risk all sorts of places, and I'm going to do my best with my money to put it in safe havens. Real things.
And so don't
real estate.
Invest into a lot of AI products on the stock market. Now I'm seeing
now if the market crashes and a winner emerges and the stock takes a beating, then maybe there's a time to buy then.
Personally, I think 10 years from now, 15 years from now, all the AI companies out there are going to be about 50% because they're going to get absorbed. They're going to get taken over by other companies. Now,
it'll be like Netscape.
Yeah, well, yes.
It'll be like
Ben Affleck's business. He has an AI business in the movie production area. Well, Netflix is buying that product for $600 million right now. Now that's small potatoes when you really think about it. 600 million is nothing because a lot of this stuff is in the billions of dollars. So that one is going to go away, but it's going to be taken over by Netflix, and they're going to make that big.
Right. Well, I mean that's a whole
and a lot of different things are going to. They're just
the whole influence of AI on social media, and honestly, I think the impact on the entertainment industry is going to be profound.
Oh yeah.
With the race for content and all of that, and there's going to be a lot of creative people.
A lot of movies made like Avatar. You don't have a lot of actors in there people-wise. It's a lot of AI.
And then AI will be the only ones that watch it. because it'll be crap.
That's probably the truth. Good point.
Let's sell some AI tickets to AI robots to watch in our AI theaters. Because I mean, look, and I get it. I just went on kind of a bleak tirade there, but
Oh, that's okay.
but I do think that we've got vastly accelerated risks right now, and you know,
I'm inclined to think that the AI is going to shape out in a different way, having lived through the 2000, and all the big run up, and everyone's like, rah, rah, everyone can do everything. You can't lose money in it. And I feel like we're in that. But there aren't as many players. It wasn't a startup that.
No, and there is one difference too, is that some of the players are the most profitable companies, whereas back then you didn't have that, pets.com never made any money.
Yeah.
But the PE ratio is still the same.
Right.
Right? So, and the difference is back then it was basically, it was about $500 billion. If you adjusted for inflation, would be $1 trillion today. But we're at the 5 trillion plus mark on investment.
Right.
So if you remember, the 2000 tech wreck did not create a recession immediately. It felt like a recession in the Bay Area. Right here in Sacramento, we didn't even feel it because we were still getting that giant in-migration from the cost of living there. Right, like it was booming here in 2000, 2001. We didn't get a recession until 2001 after 9/11, when travel got shut down and where all that disruption and uncertainty. And here's the challenge: is that uncertainty is a killer of economies.
Yeah.
That's the one thing that, for me, even if let's say we say, you know what, we took out the Shah, we took out nuclear, or not the Shah, the Ayatollah, we took out the nuclear capabilities of Iran. They're not going to bother him. We declare victory, we walk away. I'm assuming they let us do that, right? Because if I was Iran, I would keep the Strait of Hormuz shut down and create a global problem for us, right? Just because that's the only asymmetric warfare. It's the only thing they can do. Yeah. Otherwise, they're just going to get bombed again in 9 months, right? Yeah. But let's say we do that. Unless we start approaching things with a little greater clarity on that national stage, I'm afraid it's just going to be one chaotic thing after the next.
And my concern is that we don't have any national clarity right now. Not that I see.
No.
As you mentioned, both political parties are polarized, and people aren't talking to each other. And so everyone's getting the AI media.
Yeah, well,
which divides them.
When politics becomes performative for your clan, as opposed to, we got to sit down in a room with people we don't agree with, but come up with a consensus. Right. That doesn't exist, right?
Door stays closed. You stay at the table until you come to something. We'll bring in pizza, but you're not leaving until that is settled.
Hey guys, let's, unfortunately, I'm a believer. The problem is this: moderates are never radical, right? And we, in this age of polarization, this is what we're stuck with. And what we really need are moderates that could sit and say, I'm not coming at it from an ideological point of view. I'm about, how do we fix the problem? Right? And sometimes your ideas are going to be better than mine. And sometimes we have to give and take.
And that's my concern, is that more and more I see that the radicals are taking on both sides. And I think of it like a body. That is, you get enough sickness in the body, and then the whole body goes through fevers, chills, laying in bed, can't do anything until it can, until you either die,
it has to pass,
or or the whole body gets up and fights whatever.
The United States is sepsis.
And we're hoping we don't have sepsis.
No. That being said, are there some bright spots? I fear I've gloomed out this conversation too much.
Well, I think we're going to go through a potential another pause. The question is it going to be a 3-month pause, 6-month pause, until we get some kind of direction? Once we get direction, just like after 9/11, after COVID, we had a pause because there was uncertainty. And I agree with you. Uncertainty creates chaos, unknown. People will back off and pause. But all of a sudden, a direction started happening and things took off. They felt comfortable.
Well, and I think because
that's going to happen here again.
And keep in mind, whenever there's, like, the reason the economy's been flat isn't because there wasn't capital out there. It's because nobody wants to put it out there in a high risk environment where they don't. So really what you're talking about is a real phenomenon. And that is that after these periods of chaos, when calm starts to emerge, investment floods back.
Right.
In big numbers.
Right.
And the sooner we can get to that point,
right. And in real estate, I don't think in our world, because we're real estate, I don't think we're going to see a huge impact like the 2008 impact and devaluation.
No. I think we're going to be the safer haven, is what I see.
Safer haven. It's there's a real strong need. So even chaos can happen over here. This over here is going to.
And keep in mind, there's another thing that impacts real estate right now, which is we simply have not been building enough homes.
Correct.
For 30 years.
Correct.
Right? That demographically speaking, even if it becomes harder and say, the percentage of those that can afford to own a home, it's usually been around 60%, right? That's been, even if that dropped a little bit, we are so short on housing supply that it's kind of a sure thing. I mean, our biggest challenges in getting stuff built has been more about, cost of construction is a challenge right now, but it's really been about NIMBYism. It's been about local governments being difficult to navigate. It's been about state governments being difficult to navigate. It's been about a whole bunch of things that, Sacramento, where we're actually seeing a fair amount of building, still isn't building enough. Mm-hmm. If you look at where we are for population growth.
We just look outside of our door. I don't know how many units there are, 600, 700?
Yeah.
A lot. Under construction.
And it's not just Roseville, which in West Roseville, you got that whole thing blown up and more stuff in Lincoln. But, you go down south of the 50 and you've got an entire stretch of land between Rancho Cordova and El Dorado Hills, the south side of Folsom. Yeah.
That's all being
built up.
Yeah.
And so that's a good sign.
We're building out Natomas as well.
Yeah, you're right. Natomas is back in play.
We're in a very unique market here in Sacramento. We are expanding in multiple directions. You go across the country and you look at different towns and cities, Chicago, Detroit, or wherever. It's usually the growth is in one direction. Just boom, just going in one direction. Sacramento, we're going in multiple directions. We're going out north. We're going east. We're going west. We're going south.
We are the pressure valve for the Bay Area.
Land available here.
Right. So the Bay Area Council of Governments does this housing report every year. And the last I checked, they've been saying this for 20 years, that basically, based upon essentially 8.5, almost 9 million people in the greater Bay Area, that they've fallen behind in housing units. They estimate somewhere around 1 million and 1.5 million. Which is why the cost of living is so ridiculous in the Bay Area. And it's not going to get better, right? They can't, even if they were to quadruple construction, it would be years before. So we're the pressure valve market, right? We are where people move when they're priced out there, but they still want to stay in state, be close to their family and their ties. All of Central California, Inland Empire, same thing playing out. As much as there might have been a national story about, we lost population 1 year, 2020. It's kind of flatlined since then, but there's a great big shift happening in coastal folks moving inland. So when I look at a market where I would want to invest in, not just move to and live in, but invest in, whether we're talking about residential, commercial, whatever, this is a high growth market. Now, Texas and Florida and other places in the Sun Belt might get all the headlines right now. But this is one of those markets that I think, unfortunately, sometimes gets overlooked because the California narrative is cost of living, dysfunctional, homeless, blah, 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 whatever.
Rent control, everything you can start thinking of, taxes.
Right. And even then, rent control is only enacted in a few cities in limited doses. Again, all of you in the Bay Area, listen, you want better rents? I know it sucks. Get out of the way of builders. Rent control won't get you that. Rent control will get you slums. Mm-hmm. But the reality is, you know, I used to go when I was with Cushman & Wakefield, and I'd go to planning meetings sometimes in the city. And we'd hear, and these people were earnest, right? They were really concerned about poverty and how ridiculous it was that, you know, if you didn't make six figures in San Francisco, you still need a roommate. Yes. Okay, $100,000 a year job straight out of school. Anywhere else you're doing great. No, in San Francisco you gotta have 3 roommates. All right, it's real. The problem is this. They would ask questions like, why aren't you building more affordable homes? Affordable homes don't get built. New homes get built.
Right.
They become affordable over time. As long as there's a pipeline of new homes being built, affordability will come out in the mix. And what you can't do is go NIMBY on everything and say, no more building, no more building. And that's just a fact. You know, it's difficult because here's the challenge: is if we got rid of all of that. You know, I'm a 20-year homeowner. I have a lot of what I'm worth is what my house is.
Yep.
Right? And if the rate of growth and appreciation slowed down, but it means that my kids can afford a home, that might be the trade-off we all have to make. Mm-hmm. Right? If it's a society.
I think everyone here at the table would like to see more growth, more development, more new homes, more, yeah.
You know,
and it's like that in all economics. If something goes up, something goes down. Like
right.
If you have more homes, the prices and the values are going to go down because you have more supply where you only have a limited amount of demand. Now, sometimes you have a lot more supply and you have a lot more demand. Mm-hmm. Because it makes opportunities. One of the things California is great about is it's great about being a melting pot of people that do cool things.
Well, you know this better than I would. You know, we saw what happened after 2008. Suddenly, there's way too much supply. Mm-hmm. Prices did get impacted for a while.
Big time.
Right? But eventually, we got back out of it. And, you know, the reality is we don't need anything like that. I don't think anything like that's coming. But what we do need is to find every way to encourage building and more growth. And I do think that side of things, I do think that there's more of a political consensus that's building. That's not going to necessarily change the fact that there's a natural NIMBYism in a lot of folks, right? You know, if I get my community the way I want it, and then suddenly someone's saying, "Oh yeah, you can build mother-in-laws and this and that," and you know, I might be a grumpy old man, and at that meeting, and you know, and those damn Gen Zs, you know, I mean, but the reality is I do think that there's some improvement there, you know, and if I'm looking honestly against all of my economic outlook, which is not good for the stock market. Pretty convinced we'll probably have a downturn, although I think it'll be more of a garden variety downturn. It won't be a financial crisis downturn. I actually see real estate being one of the bright spots in all of it. And I at the residential level and commercial, with the office market being the one exception.
Right. I think I agree with you, because that's where you can weather the storm. That's the key. Where do you invest to weather the storm? Because the storm's going to happen. Can't stop it, can't avoid it.
And how long is it going to be?
Doesn't matter. How long can you weather the storm if you do it right?
Yeah. And let's face it.
One of the things that we believe is the single family will definitely weather the storm. So when somebody comes to us and says, I want to buy 10 units, they think they need to buy a 10-unit apartment complex. No, buy 10 single family. There's tremendous advantages to that. They're standalone. Tenants stay forever. Repairs are a little bit less. You don't have turnover as much. So own 10 units. Yeah, 10 doors.
Everybody needs a place to live.
Yeah.
Right.
Necessity of life. They need to eat, drink water, roof over the head.
We saw the same thing in retail, right? When everyone was talking about disruption from online, you know who never worried? Grocers.
Yeah.
They never had to worry at all.
And the manufacturers that manufacture toilet paper.
Yeah.
Whenever there's a crisis, there's a run on toilet paper. and if you think about it.
Hey, the economy makes me want to crap my pants an awful lot. So there you have it.
Well, it was great conversation. It was really good.
Well, thanks for having me.
Thanks for taking time.
I always enjoy hanging out with you guys and getting to hear what's going on in the residential world. For those of you who aren't aware of Joel's work and the Wright Report,
Someday.
Yeah.
Bring it back, man. We want to see it.
I'm working on it right now.
Okay. Well,
It's a good report.
One of the reasons we're old friends is not a lot of people in the residential world do this. He's data driven. And that is just so critical on the investment side of anything. I get it. You buy a house and it's an emotional decision of what you want to live in. But the investment side of things, the numbers, the big picture, that's the critical stuff. That's, really the only difference from commercial is no one's living in it. So it's all about the numbers. And, you wonder, well, why would you buy a rundown strip center in a Houston suburb? Well, actually, that might be where the most upside is.
Right.
I can buy it cheap and I can fix it up and I can re-tenant it and then I can turn around and sell it for twice as much, right? Yeah. So it's no different. Maybe the decimal points move over and it's a little bit different knowing who your end user is, but it's so always learn a lot.
Tenants into.
Yes.
Easier to get in tenants.
Yes.
In a single family home than in a strip center.
Oh yeah. Although check credit, commercial too.
That's why you have to have good management.
Right. So, but thanks for having me, guys. I really appreciate it.
Thank you so much. Appreciate it.